Hey, welcome back, class. Today we are going over one of the causes of the Great Depression, the actual thing that pretty much set everything off and set everything in motion, which was the stock market crash of 1929. And people lost lots and lots of money that day, and stocks just kept going down over the course of the next, I don't know, 4, 5, 6, 7 years. And kept going down, and everybody lost their money, and there was a big panic on Wall Street that day, and that's what we're talking about: the stock market crash of 1929. It was one of the worst stock market crashes in the history of the United States. The value of the stocks fell so bad over the course of the several days at the end of October. People lost all their savings. They ended up losing their homes, and businesses had to lay off employees, or they had to go bankrupt. And it signaled the start of the Great Depression that would last for more than 10 years.
What was it? The stock market crash of 1929 was one of the worst stock market crashes in the history of the United States. The value of the stocks fell dramatically over the course of several days at the end of October. Many people lost all of their savings and ended up losing their homes. Businesses had to lay off employees or go bankrupt. The crash signaled the start of the Great Depression that would last for more than 10 years.
So with the roaring 20s, there was a big economic boom. Okay, people were buying cars, they were buying radios, they were changing the landscape and culture of America. All right, and all this, they were buying all this on credit. All right, people thought everyone was going to be rich and that the economy would just never stop growing. Well, that's not reality. That's not going to happen, y'all. And it caused this speculation in the stock market when it happened. Between 1921 and 1929, the stock market had grown by 600%, and the Dow Jones was rising by 63 points to 381 points over this time. And it's just not realistic for, if you're a stock person, okay, for this to happen. It's just not going to happen and keep growing like that. Eventually it's going to grow and it's going to catch up, and then things are going to start falling back down. All right. So, and that's what eventually happened.
Before the crash, the 1920s, also called the Roaring 20s, were a time of economic boom and business speculation. New industries such as automobiles and radios were changing the landscape and culture of America. People thought everyone was going to be rich and that the economy would never stop growing. This optimism caused wild speculation in the stock market. Between 1921 and 1929, the stock market had grown by 600%, with the Dow Jones Industrial Average rising from 63 points to 381 points.
All right. So this crazy growth in the stock market, it wasn't based on reality, because and the economy, like I said, it could not continue to grow at this rapid rate that it grew for those 8 years. Right. So in 1929, it started slowing down. At the end of October, panic gripped the stock market. People began to sell these massive amounts of stock. They said, all right, it's slowing down. We got to sell, got to get rid of our money so we keep our money. Well, the worst days were October 28th and 29th, when values fell a total of 23%. So it fell way down in those days. And these days became known as Black Monday and Black Tuesday when it happened.
The crash. The crazy growth in the stock market wasn't based on reality, however. The economy could not continue to grow at such a rapid rate forever. In 1929, the economy began to slow down. At the end of October, panic gripped the stock market and people began to sell massive amounts of stock. The worst days were October 28th and 29th, when values fell a total of 23%. These days became known as Black Monday and Black Tuesday.
Right. So the market tried to rally, but it couldn't. It couldn't recover. So over the course of a few months, it had fell around 40%. And many of these investors in this stock, okay, in the stock market, they lost everything. All right. It didn't reach bottom until the summer of 1932, when it had dropped 89% from its peak from where it was in the 20s. So billions of dollars of wealth had been erased, and the country entered into a big economic depression. So this is what caused the crash and what happened afterwards, after the crash.
After the crash, although the market tried to rally, it couldn't recover. Over the course of a few months, the stock market fell around 40%. Many investors lost everything. It didn't reach the bottom until the summer of 1932, when it had dropped 89% from its peak. Billions of dollars of wealth had been erased, and the country entered into a deep economic depression.
All right, so major causes of this crash: wild speculation. It had grown too fast. It just kept going up to 600%, like I said. And these stocks that they were buying, they were overvalued. They really weren't worth the amount of money that they were paying for. These companies weren't worth the amount of money they were paying in the stock. So the stocks were worth much more than the real value of the companies, in other words. So that it was because of that. That's one of the things that really messed everything up.
Major causes of the crash: wild speculation. The market had grown too fast and stocks were overvalued. The stocks were worth much more than the real values of the companies they represented.
All right. The economy, it slowed down considerably, and the stock market did not reflect that the economy had started slowing down. So there were a lot of signs that the economy was struggling, but the market continued to rise because of these overvalued stocks. These stocks were, people were paying a lot more money for these stocks than the company was actually worth.
Major causes continued. The economy had slowed down considerably, and the stock market didn't reflect it. Despite many signs that the economy was struggling, the market continued to rise.
All right. People were also buying stocks using credit. All right. They were borrowing money from the banks to buy stocks, and it was called margin. All right. When the market began to fall, though, they had to sell these in order to pay their debts, and it caused this domino effect. It caused stuff to fall, keep falling. More and more people had to keep selling, trying to stay ahead of everything. And but they were borrowing money from banks, and it was called margin.
Major causes: margin. People were buying stocks using credit. Many people were borrowing money to buy stocks, called margin. When the market began to fall, they had to sell quickly in order to pay their debts. This caused a domino effect where more and more people had to sell.
All right. So it reached rock bottom in 1932, and it made a little small recovery. The market did. All right. It didn't recover all the way back to its peak value of 1929 until the middle of the 1950s. So it was over 20 years before it got back to where it was before the stock market crash.
When did the market recover? The market reached rock bottom in 1932 and then made a mild recovery. It didn't recover all the way back to its peak value of 1929 until the middle of the 1950s.
All right, comprehension questions. Around how long did the Great Depression last? Was it A, 2 years, B, 5 years, or C, 10 years? The answer is C. It lasted 10 years. That's how long the Great Depression lasted.
Ding, ding, ding. We have a winner.
Number 2, during what month did the stock market begin to crash? Which month was it? Was it A, September, B, October, or C, March? It was B, October is when the stock market began to crash. It was October 28th and October 29th, and on a Monday and a Tuesday. Whoops. Sorry, let's see if I was right on that.
Ding, ding,
yes,
ding.
It was October.
We have a winner.
All right, number 3, which of the following caused the stock market to crash? A, Mr. Sean, B, people buying stock on credit, or C, slow economy? We're going to go with B, people buying stock on credit. What do y'all think? Yes, it was. People were buying stock on credit.
Ding, ding, ding. We have a winner.
All right, people were buying stock on credit and borrowing money from the banks, and it just messed up everything. Number 4, what is it called when people buy stocks using credit? Is it called A, mortgage, B, margin, or C, certificate? It is called B, margin, when they buy stocks using credit.
Ding, ding, ding. We have a winner.
And that is all of our comprehension questions. I tried not to over-inform everybody with all of this, and I hope everybody understood it. If you didn't understand it, just let me know, and we'll try to go back over everything. And we'll actually go back over it again tomorrow in class. But you all have a good day. That's it for the stock market crash for today. And I will see you next time.